Welcome to TradeTheNBI.com. This is John's reports for the 18th of May. Well, not a surprise. We were looking for positive results from the DOC that we saw here. We had the orange dip below, midterm buyers in the form of green rising above red. The only soft spot we might see would be the dip in steel right here, which, because we're already reaching elevated levels, short-term buyers, but more than enough strength from the other two to elevate things. We'd also been seeing the magenta well above white as well as yellow too, but red leading it, meaning we could get some softness in between, and we kind of did. We hit the 23%, kind of fought back and forth, but like I said, above the 23% level, boom, and we took off once it broke through. Without any trouble whatsoever once it did that. From an NQ standpoint, identical readings. Everything was pretty much the same. And again, this is that exhaustion from the short aspect, and then the determination as to, is that enough? Has it retraced far enough? Unlikely. There's still plenty of headwinds ahead of the game as far as determining the market figures. They've pre-priced out that the Fed is going to stop at a certain point, and if that reality in their mind doesn't come true, that's when things will flip. So that may not be for another couple of months, but that gives the market plenty of time to do a nice little rally in between, and no shock. Speaking of shocks here again, we'd had the turnaround of the euro and was looking improved. And again, the pushback to the 23%, which is literally just above that break of the 0%, which was just above that 104.5 range. So it got up to 105.4. It was a pretty big return. So a lot of short cover aspects in there, and no real economic news to justify. Some may just believe that it's been oversold for too long, and it has to turn around. And that there's some plausibility to a degree when people decide that there's only so much blood in the water to take from them. And from a gold standpoint, not a whole lot movement there, because again, this is that debate between the deflationary pressures versus the inflation. And yes, there may be inflation in the near term, but looking out a little bit further, are there greater risks of deflationary pressures? And market seems to believe so. This is the same belief that they have, that the recession will be significant enough that the Fed will be forced to cut rates rather than raise them, and that's why you see the change in the perspective there. Are they outthinking themselves? Are they getting ahead of the game? Potentially, it doesn't matter. That's exactly what they're doing right now, and we're seeing it from the algo turnaround. Doesn't mean it's going to be long-lived. Any short-term news can derail any of that. When we look at oil contract, this is the one that's a derailer for everything. 112 for barrel of oil now, and that just means more pain at the pump, and that just continues to suck available cash flow liquidity from people, and then you can see rates rising as we dip back lower with TLT. And so it's just one of those where you get the market dips, everyone runs to bonds, and then the market starts to turn around a little bit, then they run back into the market and rates begin to rise. But as those rates become competitive to market conditions, it's going to be a little bit tougher for stocks to maintain things, because there's finally, for the first time in years, an alternative to the one-way selection of the market, or your alternative, which was cryptocurrencies, Bitcoin, and they've suffered as well as bonds have improved their yields, because it becomes an alternative source to hedge against the equity. Of course, these are all sitting 50% off their highs, but then again, so are a lot of stocks in the tech world, at least. ETH, again, still beautiful with those runs, and then we get the nice sell-signal clean lines from those. Like the way that one trades from an algorithm standpoint. And up at the peak here, not a whole lot happening with most of that activity. Once the magenta pops back above, it's off to the races, and it's pretty much held up there. Not too strong a breakout from that particular point, but you're going to get serious resistance most likely at the 42.30 range, or if you get past there, then 43.50 becomes sort of like the ceiling in general. From a 5K standpoint, so this all started in pre-market and created, positive extremes from the moment it broke out all the way through, and just said, you just could start marking the first plateaus of them, and then you just go back from there. So these all filled as we came back down the middle market. So we came all the way back and filled the primary run of the breakout that only left the secondary ones a little early for that to fill out just yet. That will take a little bit more substantial, but we would build up a little bit. Dips of the orange below, you get the green crossing above, right at the 23%. And so this is an adjustment I'm making to the code there, and there's a couple of others where we had some unique situations where red algo stayed on a little longer, even though we had the magenta lead. So, right over here. So magenta's leading all that, crossover with blue, and the dip of orange below red, reasonably so. Find out where I'm shy on the code with that one, but we know that to be a clear bullish behavior. So address that one and get that updated so that we'll have it. But as you can see, end of the day, after dipping right back to the same mid-level, finished up to the highs and breaking out a little bit here in the post-market. Nothing too overly dramatic, but still the range is dramatic. These are big numbers, doesn't matter as long as you're fluid to stay with the direction, which is something we've talked about, being flexible to adapt to that, particularly as we've been following with some of these 5K moves, and that just tremendous, and continue to do it. As always though, trade well, and we'll talk to you later.